Hey there, I'm Nicole King. I'm the broker owner of 41 Realty Group. I am back again today with Ian Ullman with Guaranteed Rate. Last time we chatted with him, we talked about the different types of loans. So if you did not catch that video, go ahead and go back and watch that one. Today we're going to talk about how mortgage interest rates are calculated.
Yes.
Yeah.
It's a big topic, and for regulatory purposes, I'm going to be careful as I can.
Okay.
I'm talking about them.
Yes.
So the baseline is that because you saw it on the website does not guarantee that's your rate.
Yes.
It would be a very good first point, courtesy of the internet. Interest rates are very client and situational specific.
Yes.
So the baseline for most mortgage rate pricing for secondary market is what's called the mortgage-backed securities market.
Okay.
So the better version of that with an abundance of swearing would be to watch The Big Short, minus the collapse part that's awful.
Okay.
But what that does a great job of is, the way I say it is that it takes a really convoluted process and puts it in crayon on toilet paper for those of us who don't have finance degrees.
Okay.
And so it simplifies it down to more or less when you get a home loan, your lender sells it to an investor, those investors bundle those, and then that actually becomes an investment product, a bundle of mortgages,
Okay.
called a mortgage-backed security.
Right.
Those trade on the open market. So what those are doing dictates a lot about how the front-end mortgage rates are pricing. So that's kind of the baseline that starts the process.
Okay.
From there, you get to down payment percentage. Credit scoring is a gargantuan mover on your interest rate on your mortgage.
Yeah.
Obviously, any lender or mortgage company out there builds in some margin to that pricing because they got to make money too.
Yes.
So all of those things kind of factor in. There's also loan purpose and property type variances. So for example, a manufactured home is going to rate price higher than a stick-built home.
Yes.
Likewise, a second home or investment property is going to rate price higher than a primary residence because it all boils down to risk.
Right. Yeah.
If life turns sideways, you're much more likely to keep paying your home loan than you are your second home or an investment property. Your home is going to be your primary focus of what bill gets paid first.
Yeah, that makes
and
sense.
So that risk is all priced into the interest rate factors.
Okay, and when you say it's being sold and investors purchasing it, this is why, like when you go sit down with your lender is not whoever you sit down with. So if somebody sits down with you, you're not who, or Guaranteed Rate is not who they're actually going to make their mortgage payments to, right? They're going to close that loan with you, and then it's going to be sold in the first few weeks over to whoever it actually, the investor who's purchased that.
That's a great question, which gets a little nuanced.
Okay.
Because they could very well still make their payment to us.
True,
so
there's servicing.
Yeah, there's two sides of it. Yes, there's the servicing of the loan versus the ownership of the debt, so to speak. So yeah, typically when you close a conventional loan, just as an example, debt gets sold to Fannie Mae on the back end. Fannie Mae does not do their own servicing. We don't write a check to Fannie Mae. So like on those, if we retain that servicing, by all appearances for the client, it's a guaranteed rate loan. They're going to make their payment to us. We're going to handle their escrow account for taxes and insurance and those things if that's going on.
Okay.
Or sometimes the servicing is also sold, so to speak, or transferred. And so then clients would get a notification via mail that's a servicing transfer letter that says, your servicing is going from, for example, Guaranteed Rate to PennyMac or some other mortgage servicer, at which point those payments do transition to those other servicing agents. A big piece there, which is talked about abundantly at closing with the title companies, especially, is there are laws and protections in place and methodologies. So because a big scam that people will try to perpetrate is you get a letter that says, hey, Nicole, Ian Mortgage Company bought your loan, now send us your monthly payment. Mm-hmm. And you want to be sure that you're in touch with your lender if you ever get a servicing transfer letter to be sure it's valid and accurate.
Yes.
Because if you voluntarily send a check to a third-party entity who didn't actually buy your loan, it's a whole battle and fraud claims and all those things.
Sure.
And so communication with your real estate experts in the field is the key to any questions around stuff like that.
Perfect. I love it. So that is the maybe less confusing explanation of how an interest rate is calculated and a lot of stuff that happens with the loan all the way from the time that you apply through closing and even after closing. If you have any questions, please get a hold of Ian. He is happy to explain everything for your particular situation. Again, searching the internet is going to give you some real general information, but it cannot answer the question for you in your particular situation. You really do need to sit down with the lender, have them run your financial situation, and then you'll get real answers for you and your situation. So thanks for watching. Thank you for coming by.
Yes, thank you.
We'll see you in the next video.